What's going on? What's going on? Hello, everybody. Get my goodies set up over here. Get my goodies set up. Turn my volume down over here. Woo! Well, happy Friday, guys. Getting a late start today. I'll give you guys a minute or so to hop on if you are available. Do a little bit of a later in the day stream today, guys. A little bit of what you call the walk of shame. Last night when I went to bed, I left my phone at my computer desk and totally forgot to set my alarm and put it over by my nightstand. So, needless to say, didn't wake up on time this morning. That was my bad. It happens, guys. We've all overslept. But I did get up in time for obviously Trader Nick's stream, which is important. So, 7:15, that's about the time I rolled up out of bed. My internal clock told me as I was sitting there dreaming, you should probably be up. Before I realizing what time it was, started to see the sun come out. So anyway, yeah, that's totally my bad. Full transparency. That's exactly what happened. So anyway, I just thought I'd hop on here. I like to do these 10 o'clock sessions from time to time anyway. Especially on a Friday. We don't, it's getting closer to the end of the week. We just have about another 6 hours of intraday trading left and kind of gives us a chance to kind of finish out the week a little later. So anyway, getting into today, guys, the only thing I'm interested in trading right now, really, for the most part, is 15-minute, 30-minute zones. Maybe the 1 hour zone. Just because I don't want to be, I want to be trading something that the ATR of that asset will, have a chance to get to a take profit before the end of the day. Because I do not want to be holding anything over the weekend with all the geopolitical tensions that we've got. Let me get my chart shared for you. That's just my preference. It's just too hot right now with regards to the situation over in Iran and all the convoy of ships and firepower that we've sent over there. It just takes one little spark to potentially do some crazy stuff, right? So is it smart to be holding trades over the weekend when we're talking the smaller time frames? Okay. 1 hour, 4 hour. Probably is, because we could be seeing Sunday gaps like crazy when the market opens up. Now, if you're a longer term position trader, it's not that big of a deal. It's just going to be a little blip on the radar. But when we're talking smaller time frame stuff, 15-minute, 30, 1 hour, even 4 hour, it's just not something I personally am interested in doing. So I would like to be out of trades by the end of the day. I'm paying attention to one item right now. We'll dig into it in a second here. I'm waiting on a pullback for Aussie Swiss. Okay, so we'll take a look at that in a second. And then the two trades that I talked about yesterday with you guys that I ended up closing for profits. So we'll take a look at that as well. I kind of mentioned them on Trader Nick's stream this morning. So just in case anybody pops on that maybe wasn't on that stream, I'll just kind of run through those again for you. But yeah, just taking a look here at our Edge Finder. I just want to refresh it. By the way, guys, as it refreshes here. So Trader Nick did some more awesomeness to the Edge Finder. He did another upgrade, if you will, to where now we have isolated the currencies just as an individual, okay? Just the currency by itself. So this is really awesome because especially if you're a futures trader and trading currency futures, well, this has just added in a whole new audience. Maybe it's somebody that doesn't trade Forex or CFDs. Maybe they're just a futures trader. Okay, if you're like a currency futures trader, now we've got it isolated. Trader Nick and Company got it isolated for the 8 major currencies. So this is huge. I'm sure he knows this, but this is going to open up a whole new audience to him for anybody trading currency futures. A whole new batch of traders. So it's the exact same setup, but now we're looking specifically at the individual currency. So yeah, we get the same bullish, bearish, neutral signals. Obviously, right now, the US dollar is the lone one on the bullish list at a +5. Okay, so the Dixie, we'll take a look at that in a second, but the trend is up. Good month for seasonality. Now, when March hits, obviously, we could see a difference in the seasonality. So for the rest of the month, we are still getting bullish seasonality scoring on the dollar. COT report. Okay, the most recent COT report did have a slight tilt to the from week to week net change. There was a little more bullish positioning added by the smart money. Okay, the big banks, the financial institutions, the hedge funds, the pension funds, right? All the big people that are putting large orders into the system, the interbank system as well. Okay. Crowd sentiment is not really helping us out on the bullish narrative because they're net long as well. Remember, crowd sentiment, we want to observe the masses and do the opposite where possible. Because if the bulk of traders are leaning heavily into one direction, the banks know where their stop losses are typically going to be at as far as liquidity sweeps and collecting unfilled orders as to fuel their overall moves, right? Remember, it's a cutthroat world out there in the interbank system, okay? And really in the world of trading, period. It's a cutthroat system. It's a dog-eat-dog world, shark-infested waters, right? So that's the importance of the crowd sentiment. Looking at your retail sentiment itself, put-to-call ratios, AAII investor surveys, meaning, hey, over the next 6 months, are you projecting the market to go up or down or sideways, right? That's a sentiment. That's a sentiment reading. So those 3 sentiment readings are part of the crowd sentiment, the overall crowd sentiment number. So again, they're all agreeing. They're bullish. Okay, so we can't utilize that as a contrarian signal. So that's why it's painted red. The GDP report, most recent GDP report was negative for the dollar. Okay, and then you've got a few other red boxes: retail sales, inflation. Okay, the CPI number, the year over year, interest rates, ADP, and JOLTS. Okay, as far as the employment numbers over here, those are all against the bullish narrative. But we've got things like the purchasing managers indexes for both sectors, the manufacturing and the services, that are painting a bullish picture. Consumer confidence, okay, bullish picture there. PPI, PCE, which of course is the Fed's favorite gauge to gauge inflation. Okay, even more so than the PPI, CPI, mainly the CPI. Okay, that's their favorite one. So that's bullish. That's good. Our most recent non-farm payroll number is really, really good. Remember, on that one, we had a just a short while ago, we had a forecast of around 60,000, 66,000 jobs, I think it was, that was projected to be created. But we got the 130,000 actual numbers. So it doubled it up, guys. Remember, that was a very, very strong reading for NFP, which is one of the top, in my opinion, one of the most important numbers in the jobs market when we're looking at these 5. So very strong bullish tilt. Unemployment rate, okay, we had a nice drop the previous reading, so it's looking good, bullish narrative. Unemployment claims, we did have a projection of, I think, 200 and what was that earlier in the week? 200 and something thousand, but it was about 10,000 less. Let's do this. Let's go this week. What day was that, guys? NFP. That was yesterday, right? Should have been yesterday. Unemployment claims right here. Okay. So 208,000 was the previous number, but they projected 217,000, but it only rose 3,000 instead of the 8,000 or instead of the 9,000, right? So that was a very good unemployment claims number. Again, the claims increased, but not as much as what the economist had projected, what they had calculated with all their funky math, right? So that was a great number for the US dollar. And that's why we're getting an unemployment claims bullish narrative. So you add all the boxes up, everything has a point. When you calculate it all out, it gives us a score of 5, bullish score of 5. It gives us the permission to go out and buy the US dollar. Okay. Not only as a currency index, but when paired with weaker currencies themselves. Okay. So that's the part with the currencies that he added. Again, this is brand new. This is a brand new box, just added yesterday. So it's awesome. I freaking love it. And remember, if you guys have the Edge Finder, great. if you don't have the Edge Finder, just know that whenever you get your own copy of the Edge Finder, you'll never have to pay an upgrade fee. You pay for it one time, regardless of what the price is. Nick often does some really good, substantial promos here and there. Okay. So definitely keep an eye on that if you guys are short on change. I was short on change before I had it, and I got to a point where I had to have it. So I had a negative, I'll never forget it. I had a negative $100 balance in my bank, guys. I was going through some tough times, some tough times between jobs, and I had to have it. So even though I was $100 in the hole, I still put my credit card on it to get a payment plan with it. Okay. If it's too much in one chunk, you can always, they'll always, if you talk to them, they'll break it down into payments for you. Maybe a 2-month payment or something like that, 2 or 3 month payment. Okay. If money is tight, and especially if you're in a country where the US dollar is expensive. Okay. He understands that. So just reach out to them, a1trading.com, or chime in during his live streams. He'll tell you the same thing. And he'll often give a link. So, but just talk to him. Just let him know. Okay. And they'll work with you on that. Because at the end of the day, we want more people using this, because this is what makes markets tick: fundamentals and sentiment. Remember the charts, the technical analysis, the sexy part, the part everybody on YouTube shows. That's the least important part of it, guys. If you ask all of us at A1 Trading, okay, that's the least important part. Made visual by this right here. Remember, from the GD report right here, from the GD report to the right, that's nothing but fundamental analysis. That's a perfect visual of why it's the most important, because that's what the banks, that's what the CEOs of banks, of large companies, that's what they're talking about whenever they're on CNBC flapping their lips with the host, or Bloomberg Markets, or any of these other legacy news outlets, financial news outlets. This is the stuff they're talking about. They're not talking about they're not talking about a moving average crossover. They're not talking about a 5-minute chart. They're not talking about support resistance on small time frames. Okay, they're talking about the stuff that makes markets tick. This is the reason to get in the trade. Sentiment analysis, talking about the COT and the crowd sentiment. That's the smart money relationship to dumb money relationship. Okay, this is the confirmation. So if fundamental analysis is the why, sentiment is the confirmation to go in that direction. And then technicals is the timing mechanism, the charts, guys. I call it the trifecta trio of analysis. That's just a word that came to me. Maybe I should market it. I don't know. You guys tell me. But if you go in that order, guys, it will completely change your trading around. It's exactly what happened with me, because I spent 10 years focused mainly on technicals and was getting nowhere. Now, I had learned good risk management, but I was just kind of stuck going sideways. Okay. So without fundamental and sentiment analysis, I was a break-even trader. When I added the fundamentals and the sentiment, it took it to a whole new level, and my account started going up. Remember, I dug myself on a challenge account I got a year ago. I dug myself into a $9,000 hole. Now, it was a $250K account, so I was still a ways away from, the breach number, which I think is 230,000 on that. Yeah, that sounds right. 230. No, 200. It's 220 or 230. I can't remember off the top of my head. But either way, I took it $9,000 in the hole. As soon as I picked up my copy of the Edge Finder and started following the fundamentals, the sentiment, what makes markets tick, I took it from a $9,000 in the hole to break even, and a little over. Okay, so that's just my personal testimonial. Okay, I like to mention that every now and then, just so you guys can have a understanding of how important this stuff is. So, anyway, that's my little plug on the Edge Finder, and obviously he does have a code as well for Ola Prime, which is the company I worked with. Okay, A1T35 is the code. He does have a QR code on his live streams as well. But if you guys want to just simply go to a1trading.com, or A1 Trading, I'm sorry, olaprime.com, okay, then that's where you can plug the code in. Okay, so go check that out. You can get some nice discounts over here. Again, up to 35% on the Prime account, the Pro account. and just save you some money on your upfront cost. Okay. That's the Ola Prime plug for the day. So really awesome people. Okay. I worked with them for several months. Excellent people. So highly encourage, if you guys have any questions on prop firms or anything, let me know. You guys can find me on all the socials. Okay, I've got a YouTube, Facebook, X, Instagram, TikTok, and a Reddit account for just my trading related material content. Okay, so anyway, as far as the charts go, I'll take you guys briefly through the trades that I was in. So 2 nights ago, so Wednesday evening, I got into the euro dollar short. Okay. So on the euro dollar short, and let me turn my everything else back on real quick. On the euro dollar short, I was getting a bearish signal from the edge finder, which it's, by the way, still the most bearish asset down here at a -9. So this is what I like to see. 9s or less, or I should say -9 or less, or +9 or higher. That's the very bearish. That means it's very bearish, just like it shows. We get bearish signals, and then we get very bearish. We get bullish signals, and then we get very bullish. Okay, we don't have any very bullish. So right now, if we're just looking at strength and weakness, the best asset to be trading is the euro dollar. Okay, that's why I got into that short the other day. And it's still there. So let's take a look at a chart of that, and I'll show you guys briefly. So this is a daily chart. Just looking at this from a 30,000 foot view, I see that my red line, which is my 8 EMA, is below my 21 EMA. Okay. So that's telling me from a mechanical standpoint, okay, along with lower lows and highs, from a mechanical standpoint, we are showing bearish, which is matching the edge finder, which is also matching lower lows and lower highs. So that's the confirmation that I can look for some entries on a smaller time frame. Go down to the 4-hour. This is the supply zone I was looking at. I got into the short in this area. So that's my unfilled orders that I'm looking for. I've colored it light red because it's already been used. It's already been mitigated. I don't want to use it again. I don't want to reuse it, right? So if I drop to a 1-hour time frame, now I'm looking at my moving averages on a 1-hour time frame, but I'm not using 8 and 21. I'm using 50 and 200. And these are both EMAs as well, exponential moving averages, heavily favoring or weighted towards the more recent price action, okay? So on here, the light blue is my 50. The dark blue up here is my 200. That's the trigger. The 200 EMA is the trigger. That's part of the backbone strategy I learned with Samco. Okay, as far as just looking at trends on different time frames. So this is the execution time frame right here. When price pierces the 200, that's where I want to start looking to short. But for me, I don't want to short until we bounce into an overhead supply zone. So this is perfect for me, guys. I like to see price pierce the 200 just before hitting either a supply or a demand zone. So looking at this 1-hour time frame as far as confluences go, okay, remember the rectangle is my 4-hour. So if I take 4 divided by 4, what's that? It's 1. Okay, the rule of fours. The rule of fours when you're looking at trend versus your execution time frame. So 4 divided by 1 is 1. So this is the 1-hour chart. So I want to find a confluence right here, a 1-hour supply zone. So that's exactly what we've got right here. See that indecision candle? That red candle right there? That's my 1-hour supply zone, which is also an indecision candle because it pretty much is a doji candle, okay? Sellers took price down only for the buyers to reject and push back up. Buyers took price up only for the sellers to push price down and reject it. So it got rejected on both ends. That means consolidation. That means fair value. That means they're fighting it out, however you want to look at it, but that's a very good sign. And then what ended up happening on this candle on the leg out? Supply heavily exceeded demand. We know that because when price left the consolidation, it left a big gap, okay? We got a leg out candle. You look at the candle right after, and as long as that candle doesn't come back up and test that indecision candle, then that shows that we have an inefficient market. So if I look, and what's an inefficient market? It's your gap. It's your acceleration gap, your runaway gap, your fair value gap, your novice gap, whatever kind of gap you want to call it, guys. They're all synonymous, but that shows the inefficiency. Banks like to tackle inefficient markets because there's typically unfilled orders to fuel their order in the opposite direction. Okay. Banks like to attack inefficient markets because there's typically unfilled orders on the other side of it. They have to have liquidity to fuel their orders. Okay. Hopefully that makes sense. If it doesn't, let me know. But that's for me, for my trading style, that is the absolute basic principle. Attack inefficiencies to attack the unfilled orders on the other side and use them to push price in the direction you want to take it. Okay. So that is going to be this candle. And that's why I just put a line on it. I don't like putting like too many rectangles up here. It just starts getting too messy. So that's why rather than just, because I'm going to put my stop loss beyond the 4 hour stop loss up here, guys. So I don't really need to worry about, putting a rectangle around the whole thing. I just want to see where the proximal line is of the 1 hour within. And that's that white line. Okay. So that's why I do that. I used to put multiple rectangles inside of each other, but it just starts getting too dark and heavy. And I just wanted to, simplify it. So anyway, how did I get in this short? Because I don't remember if I explained this to you guys yesterday morning or not. But what I'm looking at is once we have pierced the 1 hour, so that tells me I've got 1 hour traders watching this price zone, along with the 4 hour traders watching this time zone or this zone. So that's 2 sets of eyeballs that I want to see. I want to see a confluence of eyeballs. If a zone looks good on one time frame, okay. For those traders that trade a different zone, is there a zone inside of that zone for those sets of traders, right? That's the point here. The point here is to get as many people to pile in to take price the other way as possible. So what happens? We get the pierce, and then we immediately get a red candle, which engulfed the candle. Okay, it's pretty much a double top. Okay, if you drop it down to a smaller time frame, but the point is, we touched the top of the previous candle, and this time we went below. We pierced, went all the way down, and then closed under the bottom. So as far as I'm concerned, that's an engulfing candle. Yeah, you would have probably wanted to see price go a little higher than the previous candle, but the point is that's a very strong reaction. Very strong. Because if you were to isolate just these 2 candles and turn that into its own candle, what's it going to look like? Let me draw this up for you guys. Okay, we're talking about this. Let me try something. Might try something. Okay, so we only care about those 2 candles. Well, what's that going to look like? Let's draw that up. I'm actually interested to draw this up for you real quick. Let's see, trend line. All right, let's do this. I don't want to extend the line. I just want to leave it like that. So would you agree that's the high point and this is the low point? Again, we're only looking at these 2 candles. So what would our body look like if this were a 2 hour candle? It would look like this. Because see, I'm lining up with the bottom of this candle here. The bottom of it. We went up and then price came down. So what's this candle going to look like? It's going to look something like this right here. It's going to be red, obviously. Actually, let's do this. We're going to move it over to here. Like this. So that's what this candle is going to look like. Would you guys agree? So the bottom is where it closed. Yeah, the bottom's where it closed. And then the bottom here is where it opened. So that's what that candle looks like. Now, that's a little bit more wick underneath than I would like to see, but the point is we closed below the 50% line of that candle, the range of it, okay? So that's what the candle would look like. That's the picture I have in my head when I look at these two candles, okay? So engulfing, we close at the bottom. So anyway, hope that makes sense, but that's a bearish candle, okay? It's bearish. So that's the picture I'm looking at. And anyway, yeah, I ended up getting into the trade here. So when price closed, I want to buy the breakout. So it wasn't that candle. It was actually this candle here when we broke down here. Okay. So we break there. I enter the trade short. It drops, retrace, drops. Down here is the demand zone on a 10-minute time frame that I want to keep my eye on, which, as you can see, bounced perfectly. But I was out of the trade right here. Okay, that's my take profit, because if we look over here, there's a 10-minute base before a smash up. So I want to be out of that trade by the time we hit that demand zone, rather than just going for the bottom, the support, because basically the support would kind of look something like this, taking into account these wicks. Right? A lot of people would just say, hey, I'm going to the bottom right here as a take profit. The bottom, the absolute low. Well, if you do that, your unrealized gains have now disappeared. So I'm out of it ahead of that 10-minute demand. So hopefully that makes sense, guys. And that's exactly where I got out. So that was the euro dollar. And then I also got into this Aussie, Swiss yen. Yeah, Swiss yen. So on this Swiss yen trade, guys, I got in from this. This is a 10-minute demand zone. If I drop it down to the 10-minute time frame, it's the same thing. It's an indecision candle. It looks a lot like this one. Actually, I'll just show it to you. We'll just go show it just so that the visual is understandable, just so you understand it. Okay, demand zone right here. See that indecision candle right there? Right here, ladies and gents. That's as indecision as it gets. Really tiny, real body, real big wicks. Okay, that's the unfilled orders that I'm looking for, because it left us a gap from here to here. There's our gap, our acceleration gap. That's our inefficiency in the market. Hugely inefficient, because price just waterfalled through, just rocketed through. There was no retracement on the candle after. Okay, it stayed up there. So inefficient market. What happens if I see an inefficiency? That means there's probably going to be liquidity, probably going to be unfilled orders on the other side of it. Okay, and that's what we got down here. So that was the basis for the trade. As you can see, price bounced into that 10-minute demand zone beautifully and bounced up. Now, when we got up to this area, for those of you that might remember from yesterday, or I might have mentioned this on stream as well, we had this supply zone to worry about. Okay. Now my take profits up here, that's exactly where I got out of my trade. I ended up getting out of my trade right in this area. Okay. But I still wanted to watch here, because that supply zone could very easily have taken price against me and taken away my unrealized gains. Just like that 10-minute zone I showed you, the demand zone on the euro dollar. Same concept here. But as I knew we would get a reaction, which we did. We bounced in. It went against us for a while. This is where a lot of people might start freaking out and closing shop, right? But I trust the Edge Finder's bullish reading that we had at the time. I think we still have it. And the fact that the momentum's going upwards. I know that because the 8 on a daily time frame, the 8 EMA is above the 21. Mechanical. So higher highs and mechanical. It's positive. It's bullish. Stick with it. Trust the trend. Trend is your friend until the bend at the end, right? So we got the bounce. I didn't close out. I held on to it, and we ended up bouncing into the 50 EMA on a 15-minute, and we just went skyward. Okay. Now, part of that, let's see here. That was 5:30 a.m. my time, Central Standard Time, when that started turning around and going up. So that was 2 trades, guys. 2 out of 2 for the day, which puts me back into the green territory because I had 1 trade earlier in the week. I've been busy, guys, real busy this week, real busy with some employment stuff. So I spent some time on the charts, but not as much as I like to, not as in depth. So, all it takes is 1 good day sometimes just to change your week around. So that's what happened with me. So I'll be happy for next week. Hopefully I'll be able to not have as many distractions. I had a lot of Zoom meetings, a lot of different things I'm trying to do for freelance type stuff, okay? Trying to figure out some freelance work. But anyway, so that was my trading in the last 24 hours. Now, what have I got right now? I've got an Aussie Swiss that I'm looking at. And I don't know if this one's even, I think this one might be back to neutral. Yeah. So it's neutral 4. So it really needs 1 more point of bullish strength. But 1 point of bullish strength I like is the fact that we did bounce into a 4-hour demand zone right here. Okay. So we're currently wicking into that demand zone. So it's already rejecting it quite nicely. That's an old zone I can delete over there. So, daily, I've got my 8 above my 21. I've also got higher highs and higher lows. One thing of note, if you guys see ahead, we've got a supply zone, but we have not hit it yet. Okay, we're talking about this daily supply zone right here, which I drew up the gap on it as well. Okay. Well, look at that. You had a indecision candle. You have a bunch of wicks. You got a small real body, a tiny body in it. Okay. Real tiny body. So I want to be aware of this whole entire zone, but as always, more specifically, wherever the 4-hour might fall within there. So I'm not too worried about it yet because we haven't even touched it. We came close. We've come close, but we have not touched it. So that keeps the excitement in the game as far as possibly buying this asset. So 4-hour, that's my demand zone. If I drop to a 1-hour, my 50 remains above my 200. So that's a good bullish look on this time frame. We've pulled back to the 200 and pierced it. So that's another box checked. We've bounced into the demand zone, which is the reason to get into the trade. Okay. That's the main box to check right there. And now we have a 1-hour close. That's a box checked because it says the momentum is now turning over. So on this, I'm basically looking for, because this candle was so strong, guys, think about it. If I'm looking to, if I buy this asset and I use this as a supply zone, let's just call that our supply zone. Okay, I'll probably drill a little deeper, but that looks like a decent spot for a supply zone to take profit just ahead of. Okay, let's say we take our profit there. Well, here's the thing. What's my reward risk going to look like? Well, let's just say I get into the trade right now. Okay. If that's my reward of 26 pips, okay, then if you cut that in half, at minimum for me, 26 divided by 2, I'd have to have a stop loss of 13 pips. That's not that much. 13 pips takes me where? It takes me right here. So that's where I would have to put my stop loss at minimum. Okay. I don't want to put my stop loss higher than this swing low at all. I don't. In fact, I would prefer to even put it underneath the demand zone it bought, or that that it ended up bouncing into. But at minimum, I absolutely do not want to put my stop loss higher than the swing low. So I've got to wait. Okay. The move was so strong. It was almost too strong. Okay. It was almost too strong. I wished it would have been a little bit lower. So now all I'm looking for, because it was too strong and it skewed my reward, because it skewed my reward, now what I'm going to do is take that 1 hour, divide it again by 4, the rule of 4, and see if I have a demand zone down here closer to the bottom, a new one, a newly created one, a second chance entry. Okay. Second chance entry. So I'm looking for a demand zone further down. So, on this time frame, I've got a brand new curve analysis I can look at. Swing low, swing high. So my goal is to find a demand zone, which honestly, that might be okay. Okay, let's look at this. So this right here does technically create us a new demand zone right here. It's a little bit lower, right? Just a little bit lower. But this would be defined as the leg out, right? Well, that leg out had a wick, and it actually closed. In other words, it gave us a very tiny gap. This is a gap by definition, but it's a very weak gap. See that little white box? That's our gap, and that's just not as sexy to me. So that's why I'm not really too excited about looking at it on a 15-minute. Let's just divide it again. Let's go down to 10 minutes, actually. 10 minutes, and not any better. What about a 5-minute chart? 5-minute looks better, guys. If I go to a 5-minute, do I have a better gap? That would be my gap, which means this would be my new demand zone. Talking about that 5-minute candle, we had a leg out with a bigger gap relative to the size of the candles, and then a continuation that broke supply. This was a supply zone. This was a supply zone at one point on a 5-minute chart. What happened? We wicked into that 5-minute supply, and we got a rejection. We come back down. We create a brand new demand zone that pushes through the rest of the supply zone and closes, which shows strength with this as a impulse leg, a brand new created impulse leg. See that? That price structure here? That is a brand new impulse leg because we broke structure. In this case, it was a supply zone. What's up, Algo? Hey, brother. Sorry for getting a late start today. I don't know if you were on earlier, but I was telling everybody when I went to bed last night, I left my cell phone, which is my alarm clock. I left it on my computer desk, forgot to set my alarm, forgot to put it by my nightstand by my bed. So needless to say, I got up late, missed my slot this morning. So I figured I would just do kind of a quick makeup session today. But anyway, so yeah, that's my new impulse leg. Yes, on a small 5-minute time frame. Okay. So that tells me that I want to watch this. If I can get a discount, this will be my second chance entry. Because again, it's pushed too far on that 1-hour candle that closed, and it's completely skewed my reward to risk. So if we wait, and I'm going to set my alert there, by the way, before I forget. And Aussie Swiss is one of those currency pairs that moves kind of slow. Okay, so I'm just going to set an alert for the end of the intraday session today. All right. Now, all I need is just a touch of that zone right there. This is my second chance entry. What else is good about this? Well, the main thing is it created the impulse leg. So that tells me momentum, just like the 1-hour candle, is proving it's trying to shift. So now I just need a discount. So let's just simply come back down here, guys. Touch the 5-minute demand for that buy order. For the buy, okay? That's the way I'm looking at this since the hourly candle since it closed way too strong. That's a good sign, but it's not a good sign when you want to buy the breakout. So you have to wait for a discount because at that point, now what's my reward risk going to be? If I buy here and I measure to my take profit, which is just under this overhead supply zone we were looking at, that's now 35 pips. What's 35 divided by 2? My math sucks. So that's what, 17 and a half pips? 17 and a half pips would have to be my stop loss. And that's going to be down here. That's a better stop loss position placement. Remember, if I buy this breakout, I have to put my stop loss basically right about where basically right about where the demand zone's at. I don't want to do that. I will only get in this trade if I get a discount. So far it's looking good. It looks like we're trying to get a retracement, right? All right, retrace down to demand, and I'm in this thing. No worries. I was busy all morning again. Shaking my head. Been 3 weeks. I don't really trade. Yeah, I'll go. It's been busy for me too this week. This last couple weeks, really, a few weeks. Uh, I've been so focused on employment, trying to get a job. I did have a interview yesterday, by the way, after our live stream yesterday. This is for the financial analyst / content creator role that I'm looking for. I feel like they liked it. They did say that I'd have next step is talk to their head traders and some of the big wigs. I'm assuming like the CFO, people like that, CEO, CFO. And they said I'll hear something soon. So yeah, hopefully on Monday I'll get some info. So we'll keep your fingers crossed for me, guys. The good thing is with that role, it doesn't affect it. I mean, obviously I'll pay most of my attention to that, but I'll still be able to do my live streams. I'll still be able to create my own content, but I'll be doing it for a company now. So we'll see how that goes. But and then that'll make my trading even better because I'm not worrying so much, and I'm looking at setups a little cleaner. I mean, it's tough. Sometimes when you're unemployed, it's tough. I don't recommend anybody be a trader, at least initially, without a job. You still want a job to pay your normal bills, so that it's less stress and it keeps you out of making dumb decisions on, buying something you shouldn't be or selling something you shouldn't be. So if you have a job, if it's a shitty job, if you hate it, it sucks, at least it's paying your bills, guys, and it'll make your trading a little bit less stressful. Because when you're trading, when you're unemployed, you make stupid decisions. I'm not saying I've made any very stupid decisions, but there's a handful of trades that I'm like, yeah, I know I'm pressing this, but it's because I'm trying to get this account funded. It's trying to earn a reward on this instant funded account I've got. So there've been one or two where I'm like, that was stupid, Tiger. You broke your rules. The good thing is I have a nice trading journal, and I actually went over it last week, and I saw very clearly where I personally had some mistakes from early on. And you know what most of my mistakes were? It wasn't even really a mistake. It was the fact that I choked out my stop loss. Okay. I choked out price, meaning my stop loss was too tight. And if I would have just given it a few more pips of leeway, then, I looked at the trades a couple days, 3 days later, they would have been profitable trades. So that was my personal learning moment for me was, hey, quit choking your damn stop price out. Give it some more wiggle room. Quit trying to chase too high of a reward risk. Just stick with 2-to-1 minimum. 2-to-1 minimum. That's why I measured out 2-to-1 with this 1 hour chart and realized that it skews the reward risk. So I have to be patient and wait for the retracement to give me a cheaper price, a better reward to risk, right? So, well, I should say a higher probability reward risk. The first time I drew it up on 1 hour, that's still 2-to-1, but the problem is I couldn't incorporate this swing low. But now I can. So anyway, yeah, good stuff, guys. Good stuff. So that's Aussie Swiss. If you guys have anything you'd like me to look at, let me know. I do have some other alerts I could be looking at. But I think what I might do today is just strip away everything and look at the technicals just for a moment. What I'm going to do is pull up a double chart format like you see here. On the right side is my daily so that I can very clearly see my 8 and 21 EMAs, my 8 EMA, the dark red. And you know what? I might actually do this, guys. I think I'll make it a little thicker just so you guys can see it. Does this make it a little easier for you guys to see? It should, right? Yeah, that makes it a little easier for you to see my lines. And I'll do the same thing over here. I'm just going to thicken them up. Add a little more flour and thicken it up. Okay. There we go. How's that look to you guys? Does that look a little easier to see? I like it better too. Save that so it doesn't go away. So anyway, let's do this. Let's just take a look at some of these assets. Now, first I want to show the Dixie. Okay, the Dixie up. You can see that. Oh yeah, that moving average looks way better this way. So Dixie is up. We have chewed through this. Oh, and by the way, guys, these candle colors are going to look a little funky. It's because I'm using an indicator that just, if it's a downtrend, even if it has an up candle, like a bullish candle within, it's still going to paint it red. I just care about the overall trend on the right side. That's all I care about. Okay. I care about the overall trend. So I don't care which candles should be green or which candles should be red. It's just, hey, am I in the correct general direction? And as you can see, when it's turning green, see how it's turning green over here? Well, that's because the trend is pushing up. So even some of these red candles that you see are painted green. It's because overall it's green. I don't know if that confuses anybody or if it makes sense, but it's obvious. I mean, it's designed for keeping it simple to understand your trend. And so yeah, I've got a big batch of green candles. Yes, there are some candles. If you guys see they're outlined red, okay, that means it is in fact a bearish candle. There's a bearish candle. The current candle is a bearish candle, but it's green. It's green because the overall trending is up, because that's all I care about. And my 8 is above my 21. So bullish from a higher time frame. Okay. That's all I care about. We have pierced through this supply zone right here. Okay, we wicked through it, did we not? We haven't really closed above it, but we've wicked through it. So that's a good sign for continuation for the up move. It's a break of structure. And just to go back to the regular chart for a minute, I just want to go over here, turn on my drawings. Okay, this is our current look from a demand and supply zone perspective. Over here, we bounced into a monthly demand, okay, monthly indecision candle, monthly demand zone. Inside of that monthly, you see we have a daily, and that's the candle that we bounced off of. So price, if we rewind a little bit, price came into the monthly, it touched the daily here, and it got a big bounce. Came back down, touched the daily again, and it got a big bounce. Came back in, touched the monthly, and got a bounce. Came back in again, touched the daily for a third time. It did pierce through it, but it did not close. And then it got a bounce. Now, in the wake of price bouncing this third time, we left a brand new demand zone, brand new daily demand zone right here, a brand new indecision candle. Indecision candle, guys, if you remember one thing from today, indecision candles, meaning doji candles, meaning candles with wicks everywhere and very tiny bodies, very tiny real bodies. When you get those, you typically have an inefficiency getting ready to create itself. Okay, in this case, with that being the demand zone, our inefficiency would be this gap from here to here. That is our fair value gap showing strength from the consolidation preceding it. That's your unfilled orders. That's your demand heavily exceeding supply. And then upon the return, what do we get? You guys also see there's a green candle in there. It's because we had a 4-hour. So this is a 4-hour candle here inside of the daily. That's my 4-hour daily confluence. And then what happened? We bounced in and it pushed out. Okay. That's supply and demand. That's supply and demand zones. That's actionable ways of looking at supply and demand. Okay. And as much as I like supply and demand, remember, that's my favorite way to trade. I could almost trade that just by itself, but it's nice to have odds enhancers to help out. So RSI, moving average confirmation, liquidity, talking about the relative strength, the volume spread analysis candles, the VSA. Now we don't have that on the index itself. We have to look at that on the actual currency pairs or other assets. But anyway, that's this is showing, and this is your explanation of why the dollar is going up. Okay. Now we got our fundamental reasons, okay, our geopolitical reasons, but from a technical perspective, that's the explanation of why we're going up. Okay. So that's the Dixie. That's the Dixie, whistling Dixie. We'll take a look at a couple of these guys. I'll probably be popping off here in about 10 minutes. So if you have any other items you'd like me to look at, do let me know. U.S. oil is still giving us that strong +7 score. So let's go look at that. The oil. Okay, looking over here on oil daily chart, we got the 8 EMA above the 21 EMA. Price, what happened with price? What did it drop into? Did it drop into a demand zone? Did you do that? You little bugger, you. Did that demand zone have a gap coming out of it? Looks like it did. Now, I didn't have any interest in oil unless it dropped all the way down here to the 4-hour confluence. That's at the bottom of the daily zone, right? Sometimes the daily will catch it by itself. Remember, the higher the time frame you go, the stronger it is. So monthly is stronger than weekly. Weekly is stronger than daily. Daily is stronger than 4-hour. So oftentimes the daily will go ahead and catch the bid early. So that's what happened. That's what happened. Okay, we're talking oil here. Oil is the problem child as far as I'm concerned. I think it's from a supply and demand perspective on the zones, it's a little bit harder. I got to admit to you guys and be fully transparent. I don't really have a ton of success with oil. I really don't. It's just a lot more, it's even more, I think, fundamentally driven than it is any other asset. Meaning, good luck if you're just a technical only trader and trying to trade oil. It's just a little more difficult. I don't know what you guys think about that, but that's the way I look. Algo says, oil took so much money from me. And he's shaking his head as he types that. Yeah. Well, I haven't honestly placed a ton of trades on oil. I have a few times, a few small losses, but I just haven't had the success with it. Obviously, your crude oil inventories reports we get on, Wednesday, Thursdays, is a big factor. But really, to get good at trading oil, I think it's all about studying OPEC and, the Venezuela geopolitical news, understanding all the intricacies between all the OPEC nations and watching to see what they speak and flap their lips on. I actually saved the OPEC's website at one point. I don't know if I have it in my trading folder here or not, but that is obviously on my list, guys. I've got a list of about 4 or 5 things on my back burner of things I want to personally study and get better at and more educated on, to obviously help with the content creation side of things. Oil trading is one of them. But yeah, somewhere on here I've got it. I don't know where it's at. It might be. I got too much crap. I need to actually clean this up a little bit. I've got so many trading sites on here I've got saved over the years. It's just freaking crazy. Yeah, that's going to be another goal. Maybe I'll do that on a weekend, on a Saturday when I'm staying away from trading, right? When I'm trying to take a break. I might just clean up my trading folder because I got too much crap there. But anyway, but again, just looking at it, that's this is where I stand fast and wait. But it looks like we might have had the move early. So oil, probably not excited about it now. What about a 1 hour? Yeah. Yeah, I don't know. I just don't like it. Yeah, I mean, this is a potential demand. Maybe you could squeeze a demand. I don't know. What's a 4 hour look like? Okay. Well, here's the thing. You do have a 4 hour demand here. So that is a 4 hour demand. This would be a 4 hour demand, which is the origin of this overall strong move up that you see. This is a 4 hour demand, but what's the problem with it? What's the problem with that demand zone? Did it create itself? Why am I coloring it light green? It created itself because it bounced off the daily. Remember, a zone that bounces off of a previous zone? That's just a reaction. It's not as much of a consolidation of high quality unfilled orders as it is if it would have created itself. Like right here, this 4 hour zone, it created itself. Because if you're looking at previous supplies, well, you have a smaller time frame. This is going to look a little prettier as far as supply. But what happened? We pushed all the way through. So taking a look at these two green candles, there's no demand there. It's just straight waterfall up or rocket ship up. So what happens? Price comes down, bases on its own, not as a result of bouncing into a zone because there's no zone there. It's just a straight candle. But it bases and then pushes up and breaks structure. So that's why I'm interested in this as a demand zone instead of the one that was created at the origin of the strong move up. This is normally my favorite zones down here. But when they're created as a result of bouncing into a former zone, guys, this is 12 years of studying supply and demand zones. I've seen it way too many times. They just don't work out as well. So this is one of those opportunities that I'm not going to look at the origin. I'm going to look higher up. So hopefully that makes sense. But yeah, again, if you're really, really wanting to get an oil trade, if you're really wanting to put your money on it, that's probably the best 4-hour zone that's close. If I go to a 1 hour, I do have my 50 EMA above my 200. So that's a box checker. When price comes down, it's going to pierce that 200. And then what do we have? We have a 4-hour demand. What's 4 divided by 4? Because I like the rule of 4s when I'm going from, basically trend to execution. Well, that's 1. So we're on a 1-hour chart. So where's my 1-hour demand zone? Where's my confluence? It's going to be right there. Talking about this candle right here. So that is my 4-hour, 1-hour confluence. It has a gap above it. It's not the strongest gap. And there's one more thing we've yet to see. There's one more odds enhancer we've yet to look at. What is it? And what's the one thing that's probably going to keep me from not having any interest in this demand zone? Volume spread analysis. VSA. Okay. See those blue candles? You got one tiny green candle. See how lazy the traders were in this area? There's no volume. There's no tick activity. There's no institutional activity like you had back here. See these big red candles and yellow candles? That's high. If green is your average volume and yellow is your higher than average volume and red is your ultra high volume, then when you see a blue candle, that's below average volume. So that's what happened when this zone was created. It happened with very little interest. Okay, there's a lot of things, a lot of boxes to check to make sure we're selecting high quality supply and demand zones, and that's a big one. That's a very big one. Everything else can look great. The structure, it broke a structure. It left us a gap on the higher time frame. The 50s above the 200. When price returns, perhaps the RSI will swing below the 20 line, showing it's heavily oversold. All that stuff can look good. But if that zone was created with almost no interest down here, and that makes total sense because that's the early Asia trading session. New York is closed. London's not open yet. So this is Asia trading that created the zone. I'm not the biggest fan of trading supply and demand zones that are created in the Asian session because that's the least liquid time frame, right? The best times for zones to get created is the New York London overlap. So the end of London session and then the early part of New York session. That overlap. There's about an hour or so of overlap. 7 a.m. to 11 a.m. Central Standard Time. So we'll call it 8 o'clock to noon, New York City time. That market open until the time we reach the lunchtime doldrums, guys. That hour and a half of time in New York City where all the hedge funds are off eating. Maybe they're taking their shots. Maybe they're doing a little, little bugga sugar, that kind of nonsense, right? They're taking their breaks. They're resetting. All right. But that time from New York open until the lunchtime doldrums, that's the best time to do it. That's the best time. That's the best time to be looking for strong zones. If I have a zone that's formed in the Asia session, I don't want it. Now there's some, obviously if it's a Japanese yen based pair, if it's an Australia dollar, if it's a New Zealand dollar based pair, well, that's a little different because that's their that's their hemisphere's currencies over there. So those are a little better. Those are a little better. And those are the ones you want to be looking at during the Asian session, because that's when they're the most liquid. They're trading their own hemisphere's pairs, currencies, right? So I just don't like it. I'm going to ignore oil. You like that, algo? What is the volume called? Indicator called? Oh, it's a volume spread analysis. So if you just go to your indicators tab on TradingView and just type in VMA, VSA, and just you'll see right here, volume spread for VSA by the developer. It looks like Hari Prasad. So sounds like somebody over in India, I'm assuming, Middle East area. Okay. Volume for VSA, but you can just type in VSA and it'll just pop it right up. Now, I think volume spread analysis. Now, if you type it in, and this is why I say that, because if you type in volume spread analysis or VSA, it's going to show you all kinds of different ones, right? But I believe okay. Yeah, same thing. Even if you type in VSA, see, it's giving you all kinds of different options, right? But I care about, again, I care about this one. Volume spread for VSA. That's the one. That's the one. Now, I haven't even, in all full honesty, I haven't really played around with any of these other ones, but I found this one initially. I liked it. It makes sense to me. Oftentimes people will take volume and volume spread and kind of make a super indicator, if you will, where they're including other indicators, oscillators, volume things. But some of this stuff can create paralysis analysis. But yeah, play around with that. But yeah, specifically the one that I use has 5,500 users. So it's at the top of the list. It's at the top of the list for a reason, guys. And think about that. You'd be one of only 5,700 people in the world using this indicator. It's a powerful one. It's a powerful one. Because remember, in currencies, we don't have volume. We don't have centralized volume, right? You guys know that. It's not like stocks or options or futures or commodities. We don't have centralized volume. All that stuff has centralized volume, but we don't. So we kind of have to get a little creative with this. And we have to look at volume. And I still say volume often just because I'm so used to the word, but just look at it like tick volume or tick activity or just activity in general. So that's why I love it, because it's real easy. You can stand 10, 15 feet away from your chart and look and see a big red candle right here. You can see a big yellow candle right here. That's telling you where there's a ton of activity happening. We're retail traders. We don't have the money that they have, the big banks. So they have the power to move thousands and thousands of lots around it with no problem. So that's showing you the ultra high activity, right? When I see a demand zone formed right there with high volume like that, that's good. So anyway, hopefully that makes sense on the volume spread analysis for you guys. So yeah, I've already went over the one I was interested in the most. That's the Aussie Swiss. Let's see. Did we get anywhere close? See, it's going to try running away again, it looks like. Remember, I want this green projection. This is what I want to have. I need price to come down here. That's what I'm going to be looking for. Guys, if I get into that, I'll let you know on Monday. But I am going to go ahead and hop up out of here. I do have some other things I got to do. So hopefully that hour was good for you. And I'll try and do better the next time about setting my alarm. So with that, guys, be safe, be careful. Okay. Use your stop losses. Give them some wiggle room. Give them some breathing room. Oh, wait, one second. I'll go. Can you briefly? Yeah, I'll go. Sorry, I just saw that last question you had. Yeah, that's basically it. When I see a demand zone, I want to see ultra high volume bars created. I want to see the institutions created it and not the retail traders. So that's the key. So hopefully that makes sense to you. It's a little different on a smaller time frame, 5 minutes, okay, but that's ultimately what I want to see. I want to see the volume be much higher than the volume previous to its creation. Hope that makes sense. Increasing volume, just like you would see in the regular volume indicator on stocks or whatever. You want to see that increase. So, anyway, hope that makes sense. I'm going to hop up out of here, guys. Have a good one. Take care. See you Monday.